the appointment that should terrify every serious investor. I need you to stop what you are doing and pay very careful attention, because what I am about to explain to you is not a political opinion. It is not a prediction. It is a pattern that has repeated itself throughout monetary history with chilling consistency, and it is playing out right now in real time at the highest levels of American financial power. The Federal Reserve Chair is the single most powerful unelected position in the global financial system, more powerful in many practical senses than most heads of state. The person sitting in that chair controls the price of money for the world's reserve currency. They influence the cost of borrowing for every government, every corporation, and every household that touches the dollar system, which is, in practical terms, the entire world. When that position changes hands, and when the person taking that chair arrives with a specific mandate that departs from decades of institutional orthodoxy, it is not a routine personnel decision. It is a signal of seismic importance. And here's the signal I am reading right now. America has a debt problem that is, by any honest measure, unsolvable through conventional means. Let me be precise. The United States federal debt currently stands above $34 trillion. The annual deficit, the additional debt added each year, is running at levels that were once considered catastrophic even in wartime. The Congressional Budget Office projects that interest payments alone on the federal debt will surpass defense spending within years and become the single largest line item in the federal budget. Not healthcare, not infrastructure, not education, interest on debt, money paid to service obligations already made, producing nothing new, building nothing, employing no one. When a nation reaches the point where it cannot grow its way out of debt, cannot tax its way out of debt, and cannot cut its way out of debt, history tells us there is always one path left, and that path runs directly through the Federal Reserve. I have studied every major debt crisis in history, everyone. From the Roman Empire's debasement of the denarius, to Weimar Germany, to post-war Britain, to the Latin American debt crises of the 1980s, to Japan's lost decades. And I want to tell you something that the mainstream financial press consistently fails to explain with adequate seriousness. There are only 4 ways a nation can reduce a debt burden that has grown too large. You can grow your economy faster than the debt grows. You can raise taxes to generate surpluses. You can cut spending to generate surpluses. Or you can inflate and devalue. You can make the debt worth less by making the currency worth less. Option 1, growth is theoretically possible but realistically insufficient given the scale of the problem. Option 2 and Option 3, tax increases and spending cuts, are politically suicidal in the current environment and mathematically inadequate given the trajectory, which leaves Option 4. And Option 4 is exactly what a new Fed chair, appointed with a specific mandate to work with the Treasury rather than operate independently, represents. Let me be explicit about what canceling the debt actually means in practice, because the phrase can be misleading. Nobody is going to announce one morning that America's debt no longer exists. That is not how it works. What actually happens, what has always happened in these situations, is a gradual engineered process of financial repression. Interest rates are held below the rate of inflation, meaning that the real value of debt erodes over time. The central bank purchases government bonds, creating money to fund government spending, which expands the money supply and reduces the purchasing power of each existing dollar. Holders of dollar-denominated assets see the real value of their holdings quietly, methodically diminished. The debt is not canceled. It is inflated away, and the people who hold dollars, bonds, savings accounts, they pay the price largely without understanding what is happening to them. This is not theoretical. The United States did exactly this after World War II, from 1945 to roughly 1980, through a combination of financial repression and managed inflation. America reduced its debt to GDP ratio from over 100% to manageable levels. Creditors were systematically paid back in dollars, worth significantly less than the dollars they lent. It worked, but it worked by transferring wealth from savers and creditors to borrowers in the government, and the scale of today's debt problem is arguably larger and more complex than the post-war situation. So when I look at the profile and mandate of the incoming Fed chair, someone selected not for their commitment to institutional independence, but for their alignment with an administration facing an existential debt reckoning. I do not see a routine appointment. I see the first move on a chessboard whose endgame is already written. And I want you to understand what that endgame means for your wealth, your savings, and everything you have worked to build. Because the people who understood this in 1945 and positioned accordingly, preserved and grew their wealth. The people who didn't, who kept their savings in cash, who held long-term government bonds, who trusted the system to protect them, were quietly devastated. History is rhyming again loudly. If you are not listening, that is a choice with consequences. I want to go deeper now, because surface level understanding is dangerous. It gives people just enough information to feel informed while missing the actual mechanism that will affect them. Let me show you exactly how this works, step by step. The way a machine works. No ideology, no partisanship, just the mechanics, the plan. And I use that word deliberately because whether it is explicit or implicit, coordinated or emergent, the outcome is the same. Has several components that are already being assembled. Understanding each component individually is important, but what is truly alarming is understanding how they work together as a system. Component one is the destruction of Fed independence. The Federal Reserve was designed and has functioned as an institution insulated from direct political pressure. Its mandate, stable prices and maximum employment, was never supposed to include help the Treasury finance its deficits. The separation was the point. An independent central bank can raise interest rates even when the government doesn't want it to. It can say no to deficit financing even when politicians demand yes. Jerome Powell said no repeatedly and publicly. That is why he is being replaced, and the signal sent by replacing him with someone more aligned with executive priorities is unmistakable to anyone who understands monetary history. The independence is over. The printing press now answers to the borrower. Component two is yield curve control. This is the technical mechanism by which the debt gets inflated away, and it is critical that you understand it. Yield curve control means the central bank commits to keeping interest rates on government bonds at or below a specific level, regardless of what the market would otherwise demand. It does this by buying whatever quantity of bonds is necessary to hold rates at the target. Japan has used this policy for years. The Bank of Japan now owns more than half of all outstanding Japanese government bonds. The Fed used a version of this during and after World War II, when yield curve control is deployed. The government can borrow at artificially low rates while inflation runs above those rates. Every year that continues, the real value of the debt declines. It is a mathematically elegant and profoundly dishonest system of wealth transfer. The genius of financial repression is that it is invisible to most people. Inflation feels like rising prices. What it actually is, at its root, is a declining currency. And a declining currency is, in the context of a debt crisis, a policy choice disguised as an economic condition. Component 3 is the restructuring of the dollar's global role. This is the most consequential and the most underappreciated piece. The debt cancellation plan only works as long as the world continues to accept dollars. The United States has been able to run deficits of a scale that would have destroyed any other country because the dollar is the world's reserve currency, meaning global trade, global commodities, and global financial transactions are denominated in dollars. This exorbitant privilege, as it was once called by a French finance minister with barely concealed resentment, allows America to export inflation to the rest of the world. But that privilege is eroding. BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding roster of members are actively building alternative payment systems, alternative reserve arrangements, and alternative trade frameworks that reduce dollar dependency. Saudi Arabia has discussed pricing oil in currencies other than the dollar. China and Russia are settling bilateral trade in yuan and rubles. Central banks around the world are buying gold at the fastest rate in decades, a direct signal that they are reducing their dollar exposure. Every percentage point of global dollar reserve share that is lost makes the inflation export mechanism less effective and more costly. Component 4 is the political economy of the plan, and this is where it becomes truly shocking in its audacity. The genius of inflating away debt is that the people bearing the cost rarely understand what is happening to them. When a government defaults outright, it is visible. It is on the front page. There are protests, crises, political consequences. When a government inflates away its debt, it happens slowly, spread across millions of bank accounts and savings funds and pension balances, obscured by the complexity of monetary policy and the mundane language of central banking. Most people experience it as prices going up, not as their savings being confiscated. But make no mistake, in economic terms, it is confiscation. The purchasing power you stored in dollars is being transferred without your consent and without a vote to cover obligations the government incurred on your behalf. I have met with central bankers, finance ministers, and heads of state across 5 decades. And let me tell you what I have learned in those rooms. There is never a conspiracy in the dramatic sense. There does not need to be. There is simply a logic, a cold, institutional logic that says when the debt is unsustainable, you reach for the tools that are available and you use them in the way that causes the least immediate political pain, regardless of the long-term economic damage. The new Fed chair does not need to announce a plan to cancel the debt. The plan announces itself through the incentives in place, and those incentives are now fully aligned toward inflation, financial repression, and the quiet erosion of the dollar's value. The machine is running. The question is whether your assets are positioned on the right side of it. Everything I have described, the appointment, the mechanics, the global dollar erosion, is not a reason to panic. I want to be very clear about that. Panic is never a strategy. It is an emotion that masquerades as urgency, and it consistently leads to the worst possible decisions at the worst possible moments. What I am giving you is a framework, a way of understanding what is actually happening so that you can act deliberately, rationally, and in alignment with reality rather than narrative. Let me start with what I know from history. Every major debt monetization cycle in modern history has produced the same winners and the same losers. The losers are predictable. People who hold large cash balances in the inflating currency, people who own long-duration fixed-rate bonds denominated in that currency, and people who have their wealth concentrated in financial assets priced in nominal terms without inflation protection. The winners are equally predictable. People who own real assets, land, commodities, productive businesses with pricing power, people who hold gold and other hard monetary assets, people who are diversified across currencies and geographies, and people who have debt, because inflation benefits borrowers at the expense of lenders. Now, I need to add important nuance here, because the situation we face today is more complex than a simple replay of the 1940s or the 1970s. We are not in a purely inflationary environment. We are in what I would describe as a stagflationary risk environment. The possibility of elevated inflation combined with weak growth layered on top of a debt deflation risk, because the debt levels themselves can trigger deflationary collapse if credit contracts sharply. This dual risk inflation on one side, deflation on the other, is precisely why a genuinely balanced, diversified portfolio is so important right now. You need assets that protect you in inflation. You also need assets that protect you in deflation, and you need to hold them simultaneously in proportions that match your own circumstances and time horizon. The greatest mistake most investors will make in this environment is to bet everything on one scenario. The second greatest mistake is to do nothing at all, to assume that because the old system has survived so far, it will continue to survive indefinitely. Let me be specific about what I believe belongs in a portfolio built for this environment. Gold, and I have been consistent about this for years, is the most important single hedge against what is coming. Gold is the only financial asset that is nobody else's liability. It cannot be printed. It cannot be defaulted on. It has served as monetary insurance for 5,000 years across every civilization that has ever faced currency debasement. In a world where central banks are being subordinated to treasury departments and the integrity of fiat currencies is being systematically compromised, gold is not a speculative investment. It is basic financial hygiene. Beyond gold, real assets, broadly productive real estate in strong jurisdictions, commodity-producing companies, infrastructure assets, these provide inflation pass-through that paper assets cannot. When prices rise, these assets rise with them or ahead of them. Their income streams adjust. Their underlying value in real terms is preserved in ways that a bond paying a fixed nominal coupon is not. Geographic and currency diversification is essential. The dollar erosion I described is not a one-day event. It is a decade-long process, but that process is already underway. Holding assets in multiple currencies, Swiss francs, Singapore dollars, commodity currencies, and in multiple jurisdictions reduces your exposure to the specific policy decisions of any single central bank. This is not unpatriotic. It is prudent. The wealthiest and most financially sophisticated people in the world have always done this. The idea that ordinary investors should concentrate their entire wealth in one currency, one country, one system is a convention that serves the system far more than it serves the individual. I also want to speak to something that is rarely discussed but deeply important: the psychological preparation required to hold these positions through the inevitable volatility and noise. The path to the outcome I'm describing will not be straight. There will be periods of dollar strength. There will be moments when inflation appears to be under control and the conventional wisdom declares the crisis averted. There will be narratives, very compelling, very officially endorsed narratives that tell you the debt problem is being managed, that the new Fed chair is actually quite orthodox, that your fears were overblown. In those moments, the temptation to abandon your positioning will be enormous. This is where principles matter more than predictions. I cannot tell you the exact timing of when the dollar begins its sustained decline, when financial repression becomes undeniable, when the world's confidence in American monetary institutions reaches its tipping point. Nobody can. What I can tell you with the full weight of 50 years of studying these cycles is that the structural forces are in place, the institutional incentives are aligned, and the historical precedents are unambiguous in their direction. The machine is not broken. It is working exactly as designed. The design just no longer serves the people it was supposed to protect. America's debt will be dealt with. It always is, one way or another. The only open question is who bears the cost. The new Fed chair's mandate answers that question with chilling clarity. It will not be the government. It will not be the banks. It will be the holders of dollars, the savers, the pensioners, the people who played by the old rules in a game where the rules are being quietly, deliberately rewritten. Understand the machine position accordingly. And do not wait for an announcement that will never come, because the plan does not need to be announced. It only needs to be executed, and it already has begun.